Most people hold a fundamental belief. They believe the money in their bank account is their property. You work hard for it. You deposit it for safekeeping. You see the number displayed on your banking app or a monthly statement. This number provides a sense of security, a foundation for your financial life. It feels tangible, real, and above all, yours. This perception is understandable. It is how the modern financial system presents itself to us every single day. We are encouraged to see our bank as a simple storage vault for our cash, ready to be withdrawn at a moment's notice. Your account balance represents an IOU from the institution. This transforms your relationship from one of simple ownership to that of a creditor and a debtor. You are the creditor. The bank is the debtor. This distinction seems academic in good times, but becomes critically important when a bank faces financial distress. This legal truth carries significant weight. It means your money is not sitting in a segregated box with your name on it. It has been pooled with all other deposits and has become part of the bank's working capital. The bank uses these funds, your funds, to conduct its business, primarily by making loans to other customers. The bank uses these funds, your funds, to conduct its business, making various investments to generate profit. The bank's ability to honor its IOU to you is entirely dependent on its own financial health. If the bank becomes insolvent, the rules that govern who gets paid back and in what order suddenly become the most important rules you never knew existed. Understanding this concept sets the stage for a more sober view of banking. The stability of the entire system relies on collective confidence and, more importantly, on the solvency of the institutions we trust. When that solvency is threatened, regulators must step in. Their decisions are guided by laws designed to protect the financial system as a whole, not necessarily every single dollar of every single depositor. The stakes are incredibly high, and the tools they now use, particularly the concept of a bail-in, place the risk squarely back on the bank's own stakeholders. That group can, under specific circumstances, include its depositors. You know, this is the reality. To prevent bank runs and protect small savers, governments around the world created deposit insurance systems. These programs are a cornerstone of modern banking stability. In the United States, the Federal Deposit Insurance Corporation is the primary insurer. As of today, January 31, 2026, the FDIC insures deposits up to $250,000 per depositor per insured bank for each account ownership category. This means if your insured bank fails, the government guarantees you will get your money back up to that limit. This protection is robust and has been a source of immense confidence for the public for decades. This insurance provides a critical buffer. It effectively moves small depositors from the vulnerable unsecured creditor category into a fully protected one, at least up to the coverage limit. For the vast majority of people whose total deposits at any single institution fall below this threshold, the risk of losing money in a bank failure is virtually zero. This is by design. The goal is to ensure that the life savings of ordinary families are not wiped out by the risky behavior or mismanagement of a financial institution. When a large financial institution is on the brink of collapse, authorities face a critical choice. Their primary goal is to prevent a contagion that could take down the entire financial system. Historically, the most common tool was the bailout. A bailout involves injecting external capital into the failing institution to keep it afloat. This capital has most often come from the government, meaning it is funded by taxpayers. The 2008 global financial crisis was the quintessential era of the bailout. Governments around the world poured trillions of dollars into banks to prevent a catastrophic meltdown. The rationale for a bailout is to protect everyone. Depositors are kept whole, bondholders are paid. Financial stability is, in theory, restored. However, this approach generated immense public and political backlash. It was seen as privatizing profits and socializing losses. Healthy, profitable banks distributed earnings to shareholders and executives, but when their risky bets went bad, the general public was forced to foot the bill. Critics argued this created a severe moral hazard, encouraging banks to take excessive risks, knowing they would be deemed too big to fail and rescued by the government if things went wrong. In response to this criticism, the concept of the bail-in gained prominence and was codified into law in many jurisdictions. For years, the idea of a depositor bail-in was a theoretical discussion among regulators and economists. Then, in March 2013, it became a harsh reality in the small island nation of Cyprus. The country's two largest banks were massively over-leveraged. Bank of Cyprus, Laiki Bank. They had suffered devastating losses from exposure to defaulted Greek government debt. They were insolvent, and the country faced a complete financial collapse. Cyprus appealed to international authorities for a rescue: the European Central Bank, the International Monetary Fund. The international lenders refused to fund a traditional taxpayer-backed bailout. The scale of the banking crisis was enormous relative to Cyprus's economy, and there was strong political resistance in other European countries, particularly Germany. The decision was made to impose a bail-in. Cyprus became the first Eurozone country to apply it to depositors. The plan was announced suddenly, sending shockwaves across the globe. The execution was brutal and swift. All banks in Cyprus were closed for nearly 2 weeks to prevent a run. Long queues formed outside closed branches. The initial plan proposed a levy on all deposits, even small, insured ones. The 2008 financial crisis was a wake-up call for regulators worldwide. The chaotic collapse of Lehman Brothers and the subsequent massive government bailouts of other institutions revealed deep flaws in the system for handling the failure of large, complex banks. In response, the United States passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. This sweeping legislation aimed to overhaul the financial system, and one of its key components was creating a new mechanism to resolve failing megabanks without resorting to taxpayer money. This mechanism, known as Orderly Liquidation Authority, gives regulators, specifically the FDIC, the power to take control of a failing, systemically important financial institution and wind it down in an orderly manner, rather than letting it go through a disruptive bankruptcy process that could ignite a wider panic. A central principle of OLA is that losses must be borne by the company's shareholders' creditors, not by taxpayers. This framework explicitly makes the bail-in the preferred and legally sanctioned tool for managing a major bank failure in the United States. The legal realities of bank deposits and the existence of bail-in legislation can feel unsettling. It challenges a core assumption about the safety of money. However, this knowledge is not a reason for panic, but a call for prudent action. Understanding the rules lets you navigate the system intelligently and take concrete steps to protect your assets. The risks are manageable, but they cannot be ignored, especially if your cash exceeds government-insured limits. First strategy: diversification across institutions. Don't concentrate all your cash in one bank if your balance exceeds the insured limit. In the US, that means not keeping more than $250,000 in one bank. For more insights into preserving capital and understanding market mechanics, subscribe to our channel. We will continue to monitor these structural shifts in the global financial landscape. We are not a licensed financial advisor. The information in this video is for educational purposes only and should not be considered financial advice. Always do your own due diligence and consult a qualified financial advisor before making investment decisions.